featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Todd from FIIG Securities, and we're here to answer any of your questions on the bond market or the equity market. Feel free to pick up the phone on 1300 30 34 35. The email is yourmoney@skynews.com.au. And joining me on the panel tonight is Craig Banning. He's from NAV Wealth, and Dr. Stephen Nash, one of the experts in the bond market. They're here to talk to you about what might be relevant to you as an investor or just to educate. Hello, boys. How are you?
Very good, thanks, Mark.
Mate, last time we spoke, business was going pretty well. People were, maybe trying to buy some properties and that sort of stuff. How's it been since then?
Yeah, in the last month, I think, since I spoke to you, the biggest increase we're seeing is the number of clients, new clients actually, that are coming to us who want to plan their future.
Yep.
I think people are starting to realise that in 40 years of working, you've got to try and build enough wealth to last for 30 years in retirement,
yep.
Which is obviously very difficult. And the numbers today are still ordinary. The fact that, a 60-year-old in Australia, the average superannuation balance per member in Australia is about $75,000 at 60.
At 60?
At 60. So we've got a long way to go. We've got a long way to go. And we're it's really great to see people coming in and saying, Craig, I'm 50 years of age, I've got 10 years to go or 15 years to go. Do I have enough money, and let's start planning? It's really great.
But just wind that back a second, because that's an outrageous number at 75,000.
Yeah, absolutely.
Does that mean they put all their money into their mortgage and therefore they've got a lot of assets that are not in the...
I'd say it's a combination of things. One, in Sydney, with house values so high, I think it's mortgage, children's education, mortgage, and they probably pop out of that at about 50, starting to go, right, now I've got to start planning for our retirement.
Yeah, right.
So I think the reason it ends up better by the time they retire is it's been a real strategy, I guess, in Sydney, that people downgrade their house. They sell the house, buy something cheaper, invest the rest. That sort of saved a lot of people up until this point,
right.
Along with inheritance. They're the two big savings that we see happen in Sydney.
If my kids are watching this, continue to work hard, forget the inheritance and work on. Mate, when I talk to you about things in this genre, the thing that sticks out is that the sequestration, the risk around the reinvestment. I mean, you've been talking about that for a while. Isn't that something that you would say that's a concern, simply because when they sell the house, it might be in 2008 and the price is going down? Or
yeah, in terms of sequencing risk, yes. I mean, if people incur an investment loss at the wrong time, particularly around retirement, it can be very severe in terms of the total savings pool.
So can you just talk a little bit about what sequencing risk is for the viewers, just to so the kids can understand?
Sequencing risk is where a investment return, a negative investment return, comes at the wrong time. So it's really all about the timing of investment returns, not the size of them. Really, just the timing of them. For example, as you mentioned, 2008, someone retiring just before that did very well. Someone retiring just in the middle of it, not so well.
Yeah.
Yeah,
and
okay.
I think too the risk of the downgrade of the house issue is we've seen a huge change in the type of lifestyles people want to live in retirement.
Yep.
So 15 years ago, people would come in and say, I'm retiring, Craig. I would say, what do you want to do in retirement? And they'd all say garden. They'd all say, I want to get out in the garden. I think that's why Don Burke's backyard was so successful. Yep. Now people come in...
You ought to see my veggie patch. It's fantastic.
There you go.
I'm with them. I love it.
And when now people come in and they say, oh, I want to sell my home in the suburbs and this is what I want to buy. And they say, I want to be able to walk out the front door. I want to be able to walk down and get a coffee. I want to have lunch. I don't want to drive the car.
Well, we have already got our first email. And that makes a lot of sense, that sort of retirement story. But there's a person who's just made some money. It's Sam. I've made some good money in the equity market and I want to take some money off the table and buy bonds. My question is, should I buy fixed or floating? And that's from Sam. Doctor, what's your thoughts on, as a doctor?
That's a classic investment question, bonds versus equities. But I think there's a perception at the moment that rates are going to normalise anytime soon. And I think that's probably
so for the viewers
false.
at home, normalise being go higher.
Normalise meaning cash rate goes back to 5%,
yep.
for example, from 2.5%. So
yeah, that's not going to happen.
There's
soon.
a lot of concern in the markets that that's going to occur and that the fixed rates will go up. But the selection between fixed and floating really depends on how much equity you have. If you don't have many bonds, you'd probably be better off having quite a long bond portfolio to offset the volatility that you have in your equity portfolio. But if you've got only a few equities, looking at both floating and fixed is probably
so getting some balance around.
Yeah.
Would you talk, when your clients, what would you say to the Sam?
I mean, it's a good question from Sam, because we've had a bit of this lately where, because of the rise of the equity markets over the last 3 years, a lot of retirees are getting very high exposures. You know, I saw one the other day, 65% of their funds had grown up into equities.
Yep.
So whether you think the market's going to rise or fall, that's getting quite risky for a retiree.
Yeah, you've got
so
some
it's time to take it off the table and buy some bonds and reduce volatility.
And there's enough good bonds around at the moment. There's, you know, we were looking at some Qantas bonds today. You'll get Qantas bonds at around about 6%. And regardless of what you think of the equity story, and the government comes to buy and all that sort of, whatever you think, there's a senior debt, and you're taking some of that Qantas volatility risk where they put their hands up and say, Virgin's creating some mayhem in my life. Can I get the government to step in? Regardless of whether that'll work or not, you can get a 6% return on Qantas and not be overly stressed out. What could be stressful is the property market. I mean, what's your thoughts on the property market, Doctor?
I think at the moment there's been quite a lot of concern that we're in some sort of bubble territory and that prices are going to get out of control. There's also been a lot of debate about the accuracy of the auction clearance rate, and people are getting very excited about it. A lot of real estate agents are writing to me and saying, isn't it great? Well, auction clearance rates are now 80%, they were 50% 12 months ago.
Bearing in mind, we've just followed the property show, so to all the people in property, we do apologise.
I think some of those concerns are a little bit overblown. I think the RBA is watching the market very closely. I imagine that at some point next year we'll probably have another easing, but you know, it remains to be seen with regard to what happens with business investment.
Yeah, we'll talk about that after the break, because I think Mark's making some interesting points. We'll leave it there. We'll take a very quick break. We'll be right back to answer any of your questions and all of your emails. Take care. Welcome back to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities, and we've got Craig Banning from NAV Wealth here to answer your calls, and we have the doctor in the house. Dr. Stephen Nash, he's an expert on the fixed income market, and he can talk to you on any of those subjects. And he's a bit of an expert on the RBA, and I'll be asking him now about the RBA. Mate, they've got troubles. There's trouble in paradise. They're lucky that the currency started to go lower, but clearly the disconnect between where our interest rate settings are and the rest of the world weighs heavily on them, because we're talking about the property market prior to the ad, 3-minute ad. What's the RBA story? What do you think?
Look, I think I'd probably side with the view that Treasury have that growth will probably subside back to sub-trend levels in 2014, and will provide an environment which will allow the RBA to ease again. I think what's going on with the dollar is really related to what's happening with the US dollar, and there's been a renewed concern in markets that when the Fed starts tapering policy, they will also start to tighten policy quite quickly, and that is leading the US dollar up, and that's what's happening at the moment.
So, Craig, do your clients come in? I mean, I feel that I'm guessing that customers like yours would not like these, term deposit rates, cash rates, that this pressure going down, because they've been used to term deposits. Is it a concern for them at the moment where the cash rates are?
Yeah, for the retiree clients, that's just about dominates our conversation at the moment when it comes to portfolio construction, because they're really happy with the equity returns of the last year, and they're now the amount of money we're seeing bailing out of term deposits is quite huge, and they all can't go into equities, so that we've got to be looking at fixed income. So we're spending a lot of time talking to clients about what fixed income is, because a lot of them have been on the sidelines in term deposits for 3 years or so.
When they're all going into equities, and I get that, is it mainly self-invested, or do they all go to fund managers? We've got Roger Montgomery on next week. They going to people like Roger, or what do they do? Do they just...
Well, in our practice, we have a combination of managed and direct.
Yep.
So we're not like a traditional financial planning practice, I guess, where it would all be managed funds.
Yep.
So we're very heavily involved in direct assets, and so we use managed funds as satellite funds around the core portfolio of direct equities.
And that would be something like the Magellan would be a satellite where you'd say, listen, I want to get access to the Europe, to the North American market.
Exactly.
And that makes a bit of sense. Does that mean that you can get access to people like Magellan and talk to them about what their strategies are?
Absolutely.
Do you get drilled down that hard?
Yeah, absolutely.
And how do you find those sort of conversations? Is it a time-consuming experience for you?
For us?
Yeah.
Yeah, well, what's hard, I guess, is that there's so many providers.
That's what I mean. There'd be so many people knocking on your door saying, hang on, I know how to buy equities, really?
Yeah. So you've got to spend a bit of time, and we have research that comes in every month, obviously, that tells us what all these funds are doing.
Yep.
So we spend most of our time on that research rather than hearing from them directly.
Them individually, yeah, right. Doctor, the policymakers came out with forward guidance in a meaningful way basically this year. What can you tell the viewers what forward guidance means and what your thoughts on it?
What the Fed used to do in the old days was not really tell the market what they intend to do with rates. And a good example would be 1994, where rates were eased for quite a long period of time, and all of a sudden the Fed came out and said, well, that's it, guys, we're going to put rates up. And they did it very quickly, and the market got pretty well spooked, and bond rates went up dramatically. Now,
that's what the equity guys hang their hat on. That's what they love. 94. Yeah. This could be 94 again. That's the big deal, isn't it?
Yeah, I think a lot of people that are anti-bonds are really pointing to that and saying that could reoccur. I think what the new Fed chairman Yellen is going to do, and what she's said in the past, is that's all changed now. But what they're trying to do is influence longer-term rates, because they can't do much more in terms of shorter-term rates, and I think they really want longer-term rates lower. They've seen those rates go up in May, June, and again recently, and I imagine that over time that forward guidance will be beefed up somewhat, in the sense that they'll give indications that rates won't be tightened for quite an extended period of time, and there may be more indicators about what the economy would be doing to force a tightening, and that would be quite interesting for markets.
We've got our second email for the night, and it's from Peter, and Peter writes, the equity pundits managed to give a very simplistic view of bonds when discussed. Tapering on, bond rates up, bond prices down, capital loss simple. How about floating rate bonds? Doesn't that limit the capital loss? They imply the rate goes from 2 to 4%. So the bond prices halve if bonds have been bought at face value or below and held to maturity, never mentioned. Show me the equivalent stock purchase that is capital risk free. I really like Peter. I suppose I can, Peter's right. I mean, I think I'm waffling a little bit, but Peter's point is absolutely right. But the broader point is that the bond market is much more diverse than what the equity people seem to ever want to acknowledge or understand. And it's the same with the equity market. It's much more diverse. You can buy the four majors, Telstra. And we're never really ever saying don't buy equities. That's not the role of this show. But in terms of what Peter's talking about, if you expect volatility in interest rate settings, you can buy a floating rate note, and the one that is the latest one was the NAB hybrid. Yeah. Did you have many clients want to buy the NAB hybrid?
Yeah, absolutely.
So 3.2 over the cash rate, it moves up with cash rates going up. Yeah. It's a winning investment. Now the NAB were very clear on the risks. They articulated that pretty bluntly in all their documentation. So the investor should be pretty aware of it. I mean, did you find that was a well-sourced piece of paper?
Yeah, it was, but I think investors are still learning about all of this. But they don't know enough yet. So your book's good. I use your book with clients.
Guide to Fixed Income, it's good.
It's a great book, and that's what we've got to do. We've got to spend more time educating people.
Yeah, I think it's we're only at the starting of the fixed income world, because of we're bringing Nashi, you can talk about it better than I can, but the global penetration of fixed income is massive, isn't it?
Yeah, well, in other developed economies, fixed income is one of the prominent asset classes, whereas in Australia, a balanced portfolio is typically thought about as 75% equities, 25% defensive. Now, anyone in other developed markets would say that that's an aggressive growth portfolio. But given the performance of equities in Australia, people are very comfortable with that. If things were to change, you'll see that asset allocation change.
Well, that asset allocation has started to change now because of the global financial crisis, and people are conscious of bonds. So hybrids have picked up. That's stage one. Stage two will be, more over-the-counter bonds. With the forward guidance being what it is, Craig, how does what's the risk-return appetite look like now for your clients? Have they got a number in mind?
No, I don't think so, but clients are definitely more confident in markets today than what they were a year ago. Absolutely. Yep. And I guess that's because they're coming in for their reviews and they're seeing the great returns of the last year. And, often clients think that that's just going to continue.
Yeah.
Yep.
So that's often our job, is to say, well, this might not continue at this rate.
No, that's right. I mean, and what are your thoughts on what's the research that you're getting at the moment? What are they saying about the sort of markets, the equity markets now? Going into the end of year review, are they 2014 looks really solid, or do they say it's a breathing time?
I think for the clients, as I mentioned earlier, that their portfolios have run away a little bit, so their growth allocations climbed up to 80%, some even 85%, because a lot of these self-managed fund trustees have bought predominantly Australian shares. They've got very little asset class in international markets.
Yeah, right.
And in the last 10 years, that's been fine, but they're now starting to say to me, gee, Craig, you've been talking about international assets for a while. Look what happened in the last 12 months. I've missed the boat, haven't I? Do
you feel that they've missed the boat on that sort of stuff?
Oh, absolutely, but it's very hard. Trustees are very self-directed, with ours are, so we've got to spend time encouraging them to not only have Australian equities and term deposits and property.
And is that, again, we keep talking about the same thing, it's really just a question of the education, isn't it?
Absolutely,
everyone's constantly into the education. And that's a challenge. You've been very strong on that sort of stuff. When you look at a balanced portfolio, what are you thinking?
Well, it really depends on the age. One of the primary determinants of what your asset allocation is what your age is. So, typically for a 25-year-old, I would think something like 75% equities, 25% bonds, and as you approach 75, probably 75% bonds and 25% equities. Roughly owning your age as a percentage in bonds is a good way to, is a good rule of thumb. What you're trying to do is reduce that sequencing risk, as we mentioned earlier, so you don't get caught out just at the wrong time. And you'll find that as you grow, your savings grow in your super scheme, the multiple that they are as a percentage of your actual contributions increases dramatically because you're growing quite strongly.
Because your underlying nest egg is getting bigger, but you put in $1,000, but now you've got $100,000 and that's growing through the coupon.
If you get a 25% hit to that nest egg, say you're 25 years into it, it can be a substantial proportion of your total contributions.
At 75, it's very hard to get it back.
Yeah.
We have to go to another short break, but please feel free to give us a call, 1300 30 34 35. Email, as you know, yourmoney@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call, the Friday edition of Bonds versus Equities. And joining me tonight is Craig Banning from NAV Wealth and Dr. Stephen Nash. Dr. Stephen Nash will talk to you about the fixed income markets as one of the experts in the markets. And Craig will be here to answer any of your questions on planning and what you should do as an investor. They're here to answer any questions. Call us at 1300 30 34 35 and the email is yourmoney@skynews.com.au. I want to talk about inflation. So give me a sec. When I talk to people about inflation, they say there is none. Is that a misunderstanding of the way inflation is playing out in the Australian economy compared to the rest of the world?
Well, Australian inflation is a little bit unusual in terms of the developed world because it's still in the normal band. In other major economies, we've got very, very low inflation towards the 1 or almost 0, or in some cases even deflation. So Australia is quite unusual in that respect, in that we have the 2.5% rough inflation at this point, which is good. The problem, I think, globally at the moment is disinflation or very low levels of inflation, and that continuation of that, and what that means for the economy broadly.
Why is it good that we've got inflation at 2.5?
Well, it means that roughly our markets, our labour market and our product markets are reasonably well balanced, and we've got a reasonably healthy level, I suppose, of inflation. Having too low a level of inflation really means that economic growth is too low and that you've got problems with your labour market as you have in the US.
And so to some extent, it's like you're paying off a house that's going down in value. If you have a disinflation. For the people at home, if you've got assets that are depreciating, you're still having to put resources into it to try and sustain the value, and all of a sudden deflation means I paid off the mortgage, but it's worthless, and that's not necessarily a win-win.
Deflation is a very serious problem for central banks because they really haven't got many tools to combat it. They've got QE, as we've been talking about for quite a while, and forward guidance and a few others, but it's very difficult for central banks to treat that adequately.
Why do you think there's the potential for deflation in the United States?
Well, at the moment, inflation has been running under the Fed's target for quite some time. The Fed anticipate that it should return back to the 2% level. But the problem for the US is that massive oversupply of labour. And that, I think, is getting into price expectations and is affecting the level of inflation. There is a possibility, if that large pool of unemployed is not taken out, that we'll see further lower levels of inflation and possibly deflation. And that's what the Fed has been trying to fight against all these years.
And energy, is that another one that drives it down? The fact that the US is going to be energy sufficient in 2 or 3 years?
On a medium-term basis, that's going to be a deflationary impact. Also, we've had the oil price come off dramatically.
Imagine that, that we would have a state where the US doesn't need to import oil from, geopolitically, it'll be unbelievable. It'll be quite challenging. What happens with your customers in inflation? Are they worried about it, or do they just see it as part of life?
The thing that we find interesting is our clients come in and don't believe inflation.
Oh, right.
So they say to me, Craig, what's 2.5%? Our groceries cost more, our education
it's
kids
higher.
cost more. Yeah, they think it's higher than the 2.5%.
Yeah.
Electricity bills, all these other things. Yeah, they just sort of say, what makes up this 2.5%? It doesn't make sense. So I would answer that by saying they are worried about it, and I think that's why even retirees will consider having growth assets in their portfolio. I think they remember inflation when it was 16% and interest rates were 18%.
Yeah.
I think that still is in their minds, the people in their 70s.
We talk a lot about Sydney Airport bonds, the inflation-linked bonds, and I think the 30s are trading today at 4.75 real. Do you want to talk to the viewers what real means?
Real.
Before we do that, we'll do that after the break because Carrington has just told me that we have to go to a break. So we'll be right back after this message from our sponsors. Welcome back to Your Money, Your Call. Joining me on the panel tonight is Craig Banning from NAB Wealth and Dr. Stephen Nash, and I'm Mark Todd from FIIG Securities. We have our first caller for the night, and that caller is Andrew, and he's calling from Melbourne. Hello, Andrew. How are you?
Yeah, good. Thanks, guys. Thanks for taking my call.
Pleasure. You want to talk about quantitative easing?
Yeah, I'm just wondering at what point that might have some kind of inflationary effect in the States.
I suppose. I mean, I think you were talking also about hyperinflation, and I guess the man of the hour, Andrew, is the doctor because he's an inflation man. What's your thoughts on QE and not just in the United States, because it's Japan, it is Europe. There's a QE world out there. So what's the chance of that inflation? Is that something that QE could be the view on inflation around the whole world, or is it going to be separate for different countries?
Look, I think what the authorities are trying to do is, now that they have rates at zero, they're trying to stimulate the economy in another way, and that is by trying to pull down longer-term rates to allow borrowing even more cheaply in the longer end. Given that the short end is about as cheap as it can get, they're trying to hold those longer rates down a little bit by buying a few bonds and reducing longer-term rates. Now, the common question, of course, is this going to lead to a lot of inflation down the track because the Fed is buying a lot of bonds and rates are too low and that the economy will come surging back? That's effectively what the Fed want. They want that problem. They're basically saying, give it to me. I've got the tools. I can raise rates. If I get that inflationary pressure and the economy comes back strongly, I've got the tools to deal with that. What they haven't got are tools to deal with things if they go the other way, particularly on the deflationary side. So they're trying to stimulate the economy to give them the problem that they can really treat.
So, I mean, I know Andrew's hung up, but essentially, if you think of when people talk about Japan as that lost decade, that was the problem. They had no inflation, they had no assets growing, and to the doctor's point, they want to take that problem to themselves to say, right, now I can do something with it, which generally they use some brutal tools around lifting the cash rate, so it'll stop the growth. But also, if you think about the Keating experience where he uses the accord, they start talking about the wage pressures and the like.
Yeah.
So, real interest rates. When we talk about inflation, and we're going to bring Craig in soon because at the moment it's going all to you, we've got to stop that.
Yes.
What is real for the viewers at home? What does that mean?
Real is just the spread above inflation. So when people talk about real rates, all they're talking about is the spread above inflation. So 4% real, for example, is 4% above the rate of inflation.
Whatever inflation is. Yeah. So mate, when you have clients come in and we say, okay, well, you'll get something like Sydney Airport bond, and you can't speak about that one specifically, but Sydney Airport trades at about 475 real. So inflation, whatever it may be, if it's 2.5, whatever, and then you get 475 on top.
Yeah.
Is that the sort of thing that your clients would say, I just don't believe it's available? Is that the issue?
No, I think they're keen on it because one of the things I've seen in the growth of the self-managed fund industry is clients want transparency more than they've ever wanted before. So they love the idea of they can see the income coming into their portfolio.
Yeah.
So the fact that term deposits have dropped and they're now saying I can't do 3.5% anymore, let's look at the alternatives, and they're interested in those types of options versus just throwing into more yield focused stocks.
We have I think it's our second email for the night, and it's an email from John. I'm sorry, it's our third email, beg your pardon. I got interested in equities when online broking started. I could do my own research, see the market depth, execute my own orders, etc. Do you think a similar online facility for bonds would encourage retail investors to look more at buying bonds? What do you think?
Definitely.
Yep, I think it's a no-brainer. John, it's a good point. And I think the follow-up is then why isn't it happening?
Yeah.
And to some extent, it's about the transmission mechanism. So in what way do you do that? I mean, if you look at the bond market, it in itself trades very comfortably at over the counter, doesn't it? Actually, the volume of bonds go through, they're billions. In November, there was 100 billion in bonds issued. No problem. Everyone's just buying bonds, it's all fine. So they don't necessarily need to do it. And the regulators are saying, but all the investors need fixed income. So it's a question of who spends the money to create that infrastructure, that architecture. And that architecture has some challenges because you need to have people who are price makers in bonds. You need to build it up. To John, will it happen? Yes, it's definitely going to happen. Will it happen next year? Probably not until somebody is engaged with a big wallet. But I think it will ultimately happen because at the moment the ASX has put bonds on, Commonwealth government bonds on the ASX. You put the thing that no one wants.
Right.
You spend all that time doing that, and that in summation, and I don't want the ASX people to send me an email saying I'm an idiot, but that sums up the problem. They've spent a lot of time getting the infrastructure right for something people don't want.
Yeah. What people really want is yield, I think.
Yeah.
And a lot of high-yielding issuers would love to issue directly to investors, but the problem is it's very costly for them to produce a full prospectus, and every time they do a bond to issue that. I think the regulators have got to, as I say, back off to some extent and allow more standardised, possibly standardised documentation to allow less expensive issuance of bonds by a lot of the small to medium-sized firms who are happy to issue at 400 to 500 over swap.
But the other point about this is this constant disclosure. So one of the things with the bond market is they're saying we are worried about the level of documentation required. But if it's an ASX listed company, I don't know that the level of documentation is going to be somewhat different. So as an adjunct to being an ASX listed company, they should be able to issue some debt. At the moment, they can do it. They can do it in private placements, and I think your customers would love that sort of.
Yeah, they would. It's just this consumer protection again.
Yeah.
Everything's restricted by consumer protection, and then a lot of companies don't want to invest the capital to get these things.
Yeah, and you've got to, to some extent, I understand with Storm and all the different crises that you've got to sort of protect you from yourself.
Yeah.
And I understand all that, but at the same time, you think of the benefit that the bond market brings to people in terms of, I've still got some of the shares that I could never get out of, so don't worry about, we can all get the wrong ones, and we talk about liquidity. It's not that liquid. If you're in the top, stocks, it's fine. But some of these, you must have clients that have got some things. You go, get out of that bottom drawer.
Yeah. I see things like, what is? I've never heard of that.
Yeah. And how do they buy it? Somebody told them over
it's
coffee.
Normally a friend. A friend said I should buy this. Great tip, all that type of thing.
Oh my God. Look, we'll have to leave it there. We'll go for a very short break, and we'll be right back after a word from our sponsor. Welcome back to Your Money, Your Call. It's bonds versus equities, and joining me tonight is Craig Banning from NAB Wealth and Dr. Stephen Nash. They're here to take your calls, and we've got our second caller for the night, and that caller is Duncan from the Gold Coast, and he wants to talk about currencies. Hello, Duncan. How are you?
G'day, gentlemen.
G'day, mate.
I just got a question in regards to Australian dollar, and I mean, I don't know, but what would happen if the Australian government, for example, purchased a couple of $1 billion worth of US dollars for some of their nation-building ideas, and then the contractors use that money, I suppose, periodically as they worked on projects, using the Aussie dollar as it reduces down, buying high now and selling those US dollars when it's more powerful against the Aussie dollar.
So so what you're talking about is the government trading the Aussie for the purposes of some infrastructure trades. Is that what you mean? Oh, I've lost Duncan. I think I got the sense of it. The trading in the currency.
Yeah. The Australian government typically doesn't borrow in other currencies apart from the Aussie dollar. It used to do, in the old days, it used to do some US dollar issuance and things like that and hedge them back. But typically it's all in Australian dollars at this stage.
So Duncan, the Australian government came out with a 20-year bond. That's why they issue bonds. So they came out for the first time a 20-year bond. They said they wanted, I think it was something like $4 billion. They had bids for $6 billion, and it was completely oversubscribed. So they don't want to be in the business of trading FX. That's just not what the government wants to do. And the RBA, if it was to put up its hand to say, look, we want to trade currencies, it used to do that, but it found that once the market identified the RBA was in the market, they always wanted to take the other side. They wanted to...
Yeah, the RBA has been talking recently about the cost of intervening at the moment. For example, if they intervene in the Australian dollar, they sell the Australian dollar, they've got to buy a lower yielding currency, and it has like a negative carry for them. So it's quite expensive for them to do that.
Just for Duncan, when what Nash is talking about is when they get the US dollars, they have to put it somewhere, and they put it in US government bonds, which give you half a basis point. So that's the low carry. So they're actually selling assets that produce 4% to buy assets that produce 0.5%. And they say, we're losing money on the investment straight away. Forget what happens with the currency. If it doesn't move, you really get belted. The RBA was doing that because they're worried about the economy and their currency and trying to make it more mobile. What do you think of the economy?
What interests me with the economy is how it's changing. I mean, and what I mean by that is I think we're going to this real technology revolution period where if I look at the last 5 and 10 years, technology has improved companies internally and business to business, but there's not been a lot of development between business and the consumer.
Yep.
So my thought on that is, for example, when you think of what we do now, where we buy our groceries, all goes on credit card, everyone knows what we're spending, the consumer, what I'm really keen to see is how business will change into the future around consumer sentiment and spending, and then how companies were going to start marketing direct to that consumer because they know everything you're doing.
Yeah, that's right.
So there's going to be this whole explosion of new companies into the future that we haven't seen in the past.
We just issued a bond, not the last one, the one before that, for a company, 4 years PMP, and I think it was 8 3/4. And PMP's the major part of their business is they make the catalogues for the newspapers for all those companies, and they were talking to us about the evolution. They said 58% of all households read those catalogues, and from that 58%, 52% act on them. An amazing data point. But they were saying the way that's growing is that if you live in DY, you'll ultimately start getting catalogues that'll be suited to that area, that postcode.
That age group.
Yeah. That's quite amazing. That's quite scary, you know. I open the paper and they're smiling at Mark. You know, buy your wife some jewellery.
I know what you're up to, Mark.
Absolutely. Nashi, tell me about. We've got 3 minutes before the next break, so talk for less than that. RMBS, residential mortgage-backed securities, funds all the banks. The banks have 90% of all mortgages. Can you tell the viewers what an RMBS is?
An RMBS is a security that has various...
This is a bond?
Security or a bond that has a tranching of risk. Typically, it has a highly rated piece, typically AAA, and then there's more riskier pieces that give higher yield. So the people that hold the highest quality piece get the lowest yield. The people that hold the riskiest piece get the highest yield. And some of the risky pieces can be quite risky, but most of the institutional market buys and most of the issuance is in the high AAA piece, and that's traded in the institutional market quite a bit. The spreads have come in quite dramatically in the last 12 months as confidence has come back to that market, and we haven't had any of the experiences that have occurred in the US. Very solid securities and really not risky, particularly with regard to the AAA pieces at all.
And this is the way the banks get the debt off their balance sheet.
It's a way of managing their capital, so that they securitise these mortgages and effectively get the capital back. After they've lent to the mortgage, they effectively get the capital back from the institutional investor.
What's your thoughts on the banks at the moment as an investment group? Is it something that you feel that there's just that natural comfort now with the banks in terms of the dividend yield?
Definitely, absolutely.
They've in bed with the devil and the devil being, I promise to make this dividend yield regardless of whatever happens to my business.
Yeah. So I think it's going to be a long time before Australian investors lose their appetite on our banks.
Yeah.
They've just had it too good for too long. But we talk about it all the time that don't think our banks are always going to perform like they have in the last 10 years, especially now they're all going off in different directions, aren't they?
Yeah, absolutely. We can talk about that after the break. We will go to another short break. We'll be right back in just a moment. Welcome back to Your Money, Your Call. Joining me tonight on the show is Craig Banning from NAV Wealth and Dr. Stephen Nash. I'm Mark Todd from FIIG Securities. We're in the last segment of the show. I just wanted to talk to you a little bit, Craig, about the fund managers and the offshore fund managers, and how has that been sold to your clients, and what are their reactions to the fund managers nowadays?
So the first thing we notice is the huge demand that trustees of self-managed funds or clients have on transparency. They want to know where their money's going.
Yep.
And that's very, very different to 5 or 10 years ago. 10 years ago, they'd look at a managed fund, for example, they'd look at their past return and they'd say, happy with that.
Yep.
Now they're saying things like, but what are the assets, Craig? What are the stocks? Which countries are they invested in? And should I trust them?
Yeah.
So there's a big shift, and that's a challenge for the funds management industry, I think, to try and build as much transparency in their products as they can, I guess, without giving their competitors...
Yeah, and also building that level of trust, isn't it?
Absolutely.
That's been the greatest problem, because because you don't charge any trailing commissions or anything.
No.
And so you'll set somebody up, you'll charge them X thousands of dollars, and you'll do a strategy paper. Is that what you do first?
Yeah, so when we meet a couple, the very first thing we do is we sit down with them and say, what are your goals and aspirations? We'll try and get both couple on the same page, which is sometimes challenging.
Trust me.
And then we work out where they want to go. Once we work out their strategy, then the portfolio comes behind that as a separate paper, really, as a separate.
And how often do you update and review this? Is that an annual event?
No, quarterly or half yearly or yearly, depending on the client.
Yep.
And what's changed, I think, within the portfolio is that many advisors like us don't get commissions anymore when they invest into these products. So gone are the days where they would think, well, Craig, are you recommending that to make money?
Because you're getting money, yeah.
We're not being paid. It doesn't matter where you put your money.
There is definitely an increased level of aggression around all those fees and the transparency, and I think that's hard for people to come to grips with as the product provider. How do I articulate articulate what I'm doing. But that, you know, that's, you got to adapt. That's what you got to do.
Well, I think people need advice. It's so complex. People, you know, you might be a great plumber or you might be a great teacher. It doesn't mean you know about money and investing.
And you start really late. As you said, 60-year-olds coming back and saying, I want to be an investment advisor, and that's a challenge in your own fund. I think that's all we have time for today, so thank you very much to both my guests. I've had Craig Banning from NAB Wealth and Dr. Stephen Nash. They've been here. They've been great answering all your questions in the emails. Until next time, I'm Mark Todd from FIIG Securities. Have a great Friday night. Enjoy the weekend.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.